Hi, the research team met last week to discuss the high conviction list, and we decided to leave the list unchanged. We made 6 new additions to the list last month, and we choose to sort of retain and reiterate our positive view towards those stocks. There was plenty of discussion this month, particularly around some of the healthcare names, given where the companies have fallen over the last month or so. On the back of particularly on the stronger US dollar. Now, there's about an 80% correlation between the healthcare stocks and the currency. So at this stage, whilst we do see a bit more downside risk to the Aussie dollar, where it is now at about 77 cents, we still think it's a little bit too early to dip into the healthcare names, just given the looming May budget. And also just concerns around the going into an election year. So at this stage, we're holding fire on some of the healthcare names, although we are starting to, the valuations are starting to look more attractive. We also discussed some of the more currency exposed names, IPL, Brambles, Amcor, QBE, particularly given the run in the US dollar. But once again, we just think given the uncertainty in the near term over central bank policy, we think the currency may sort of hold out at around these levels just in the very short term. Growth in the market, currently EPS growth is about 2.3% if you X out energy, materials and financials. So a very low bar to jump over at this stage. So we do prefer companies that have sustainable earnings certainty, sustainable dividend certainty and dividend growth, particularly in such a volatile market backdrop. So as I said, we've made 6 changes to our high conviction list last month, and we reiterate our positive view on those stocks. We believe that these stocks are well placed over the next 6 to 12 months to outperform in the current market backdrop. So in terms of the stocks that have been added in the ASX 100, we have Westpac, AMP and Aurora. And then in the X100 list, we have IPH, APO, APN Outdoor, and also RCG Group. So very quickly, just touching on some of the stocks and why we like them. In terms of Westpac, obviously very defensive exposure to the Australian housing market, smaller proportion of commercial exposure, where we're seeing a little bit of pressure on the funding side of things and in bad debts. It's most leveraged to the upside when interest rates do go up, particularly even out of cycle interest rate rises, and it's got a strong capital position. We also think it's one of the banks that will hold up better in terms of its dividend certainty. We like AMP, blue chip stock, very difficult to pick up this stock at an attractive price. It trades on historically about 15.5 times, currently on about 14 times. It's receiving strong fund flows into its wealth division. It's making a good progress in its in costs. And we see it's a turnaround in its life business as a positive for that stock. So that's AMP. We also like Aurora in the ASX 100. Very defensive earnings growth. 60% of it is leveraged to defensive industries in paper and packaging and beverages. Solid market position, market leader in Australasia, number 2, and in the US it's number 4 there. And we see, despite having a very defensive growth profile, we see opportunities for M&A for that company to grow moving forward. Very capable management team, and given the fragmented nature of the US market, we think there's plenty of opportunity for that stock to continue to grow. Outside of the 100, we like IPH. The stock had been caught up in the high PE stock sell-off, yet it had a very strong result, achieved organic growth in the vicinity of 23% in EBITDA, particularly in a low growth environment. That's very impressive. It's got just over 100 million in cash yet to be deployed for acquisitions, and we see them as happening within the short term, so within the next 6 months. So plenty of scope for growth there. We also like APN Outdoor, market leader, obviously in the outdoor advertising. January and February industry statistics shows that revenue growth has been well in excess of APN Outdoors stated guidance for FY16. So we think that stock will, given another couple of months of really strong industry statistics, will have to come to the market and upgrade. So we think there's a very strong chance that that will happen. We continue to like the stock. It's obviously playing that recovery in the media advertising market. And also, finally, RCG had been added to the list last month. We think it's fairly conservative guidance. For a retailer, we're looking at about 50% earnings growth over the next period. And the key overhang of the Skechers license agreement has now been extended out. And it's got a very strong portfolio of brands underneath it, including Skechers and Vans. So they're just 6 of the stocks that had made it recently to our high conviction list. We think these stocks are well placed in the near future to perform over the next 6 to 12 months. So please have a look at the note. Thank you very much.